All right. Well, good morning, everybody. We wanted to reach out to you guys quickly so we can discuss the volatilities in the market. And today we had the opportunity to bring in Bryce Gill from First Trust. He is one of their lead economists and national speaker. So, Bryce, thank you for your time. I know this was a last minute getting to you, so I appreciate you being available so that we can share with our clients what's going on with the world today. And let's just dive in. So, tons of volatility lately, right?
Yep.
And so we've spoken with a lot of our clients, and volatility is a concern. So, what are the primary factors that you see driving the volatility right now? And do you see this continuing short term, midterm, long term?
Yeah, absolutely. Well, at first I'll say, hey, good morning. It's nice to be with you, Tyler. It's great seeing you, and I'm happy to be here with you and your clients anytime. And yeah, obviously things have been volatile. Market's been selling off. We're in, I think, officially in a correction with regards to like the S&P 500 and the Nasdaq. And so I guess most of this is getting laid at the feet of tariffs, right? That's sort of the justification that's given if you look at any of the mainstream news channels or the newspaper or whatever. And I don't doubt like uncertainty around tariffs has been like a catalyst here. But generally speaking, I just think we came into 2025 with a market that was somewhat overvalued. I think we were set up for a correction here. I think the market was looking for a reason, to have a correction. And so, yeah, I get like there's uncertainty around tariffs, but if you actually look at the studies around tariffs and the economic impact that would result from, let's say we actually put in all these tariffs, right? Like Canada, Mexico, China. And for the record, like I don't think most of them will go into place and remain in place long term. The impact on the US economy is like minus half a percentage point to GDP, right? So it's a really small effect. So I don't think tariffs by themselves can like crash the economy. I think mostly what we're seeing right now is just the media reacting to the Donald Trump show again, right? And maybe that's translating into some volatility in the markets. Will it continue for the medium, the long term? Donald Trump likes to kind of change things up, and he's really good at using the media to get his message out there. And I'm sure the market's going to continue to bounce around. I don't think that's because of tariffs, though. I think it's, if I was going to really isolate a factor, it's because of where interest rates are at. Interest rates have been high. The Fed's cutting, then they're hiking, then they're cutting, then they're pausing. Inflation's not really cooperating. Long-term interest rates and profits are what really drive the market. And so we have this like 10-year treasury yield that just bouncing around like a tech stock. I think that's really what's creating most of the volatility in the stock market.
So that leads right into the next question. With inflation, it's been a major concern really since 22. And so where do you see inflation going? I know the last report, inflation dropped a little bit. So where do you see inflation going in the next year or two?
Yeah, so big picture, okay, inflation's been 2%. That's been normal for like 30 years. But if you look at the 100-year history of inflation, it's like 3 or 3.5%. Okay. And so I always tell people, hey, 2% was normal the past 30 years because we had the biggest boom in globalization in modern history, right? Like Soviet Union collapse, China joins the WTO, we create NAFTA. So we like outsourced a lot of production in the US. That's great because we get to use cheap labor and all those cost savings from labor, like the consumer benefits, right? So price inflation goes down, but our supply chains got long, complex, they fell apart during COVID, and politically that's just untenable. And so we've, post COVID started this huge effort to bring production back to the United States. We're having what I call like a reshoring boom, bringing factories and other like geopolitically important industries back into the country. And this is happening pre Donald Trump's second term in office, right? It's happened under Joe Biden as well. But hey, if cheap labor made inflation 2% and cheap labor is going away and we're now bringing all this production into the US, we're more self sufficient from that, right? There's benefits from it, but the trade off was probably higher baseline inflation. So I think the Fed's not going to be able to get to 2% inflation. I've always been saying, hey, I think baseline inflation is just higher now. Maybe 2.5% inflation is baseline in like a recession or a slowdown. Maybe 3% inflation is normal in like an expansion. So I think we're just dealing with higher baseline inflation from globalization reversing and bringing all this production back home.
How do you think markets are going to react to that? Like if we just have a constant higher level of inflation, is that going to bring the market down? Is that like, what's your outlook on the markets and what it's going to do to that?
Yeah, it seems to me the market still hasn't really adapted to like this new status quo. I think a lot of people that exist in the modern industry have spent their entire careers with an activist Federal Reserve that'll step in and like bail us out if there's a recession or financial crisis or a market crash. That's because we had a 30-year bond bull market, right? Interest rates were falling the whole time. Well, then the Fed caused the worst inflation in 40 years during COVID. And so now they're way more hesitant to just step in and cut rates to help the stock market. So like pre-COVID, right? The Fed would always talk about like the wealth effect. We want to maybe we'll cut rates because then stocks will go up and it'll make people feel richer and go out and spend, and that's good for the economy. You don't like really hear about the wealth effect anymore, right? So I just think the Fed is much more hesitant to save the day because inflation's higher now. It's higher than their 2% target. And so this almost like backstop to the market has sort of gone away. Like the Fed's not just going to step in and save the day anymore. So I think basically higher baseline inflation means the Fed can't save us the same way they have the past 30 years. That doesn't mean like the market's going to collapse. I'm not really expecting that. It just means like recently, hey, we have this tariff worry. People are worried about a recession. The 10-year treasury yield falls a bunch. That's just because people expect the Fed to cut interest rates to help out here. They can't really cut interest rates with inflation at almost 3%.
Right.
So I think long-term interest rates are going to go right back up.
So yeah, that was my next question. Where do you anticipate interest rates going in the future? So even when we look at last week or the week before, whenever the report came out that inflation was on its way down, do you see the Fed lowering interest rates anytime soon? I know that they've said that they're not going to touch rates this year, but what's your outlook?
Yeah, I mean, like, listen, the past like one or two inflation reports, inflation has like slightly declined, right? But then like the previous five inflation reports before that, inflation was rising, right? So on net inflation in the United States, like headline inflation, it hasn't really changed in the past year. It's still well above the Fed's target. And so my guess is the Fed's completely paused this year. I don't think they're going to cut if we have like a slowdown in the economy because inflation's still too high. And so my guess is that they're paused. I think it's extremely unlikely that they hike interest rates from here. But because I think inflation like baseline's 3% maybe. So I don't think inflation is going to get high enough for them to actually start hiking again. But I also find it very unlikely they're gonna cut further, right? So I just think they're paused. I think they're standing pat, they're sitting on their hands.
Yeah. So the when we're facing a situation like this, obviously our clients are coming to us with questions as to where do we go, what do we do. I don't see this correction as any reason to panic. What insight can you give to our folks out there in regards to where we should be putting money, what changes could and should be made? Any insight, any direction we can go in that?
Yeah, I guess I'll say like, hey, we've had 2, 3 really good years in the market, right? Like 2 double-digit percentage gains in the market the past couple of years. Now, those are really concentrated gains at like the top, and everybody was warning about that for years, right? So again, it's this like correction is not that surprising, I don't think, from just like an insider industry perspective. And if we just look at the math, guys, like we're back to where we were in October of last year on the stock market, right? So this is just not that consequential of a market move, at least in my opinion. And I think when you look at the math and then you kind of compare it to, I guess, the way this is being framed or like the media narrative around it, like, oh my God, tariffs are destroying the economy. Oh my God, we're going to have a recession. Oh my God, everything's falling apart. You see like the mismatch that's happening here, right? I think tariffs and I think the market decline are a great way to generate clicks and like media attention. And I'm not saying it's a good thing that we're having a stock market correction necessarily, but just from like a math perspective, I don't look at this as like the end of the world. I think the stock market will bounce back. We needed a correction to make things look a little bit more reasonably valued. I think we had into this year overvalued. So overall, I think when we compare like the math to the narrative, it's sort of illuminating in a way, right? I think this is a great story to latch onto, and the Trump reality TV show, right, is at like the center of all this.
Well, it's the media's job to sensationalize everything, so they're doing a good job with this. So, what trends can we look at as we're trying to forecast or trying to position ourselves over the next year, over the next 2 years, over the next 5 years? What trends can we latch on to benefit ourselves, benefit our clients?
Yeah, I think from like an investment perspective, what I always emphasize to people, and I talked about it a little bit here, but is like the reshoring situation, right? So like for 30 years, we sent factories and everything abroad, and that's really good for inflation. It keeps interest rates lower, maybe. It's good for like profits in the stock market and things like this. But domestic workers kind of got the short end of that stick, right? Because a lot of jobs went abroad, their negotiating power went down. Now we're reversing that, right? We're bringing all this production back to the United States. We're reindustrializing. We're building all this infrastructure. And so I think like a longer term trend here is going to be this reshoring trend. I think we're going to build a lot of factories. We're going to build a lot of infrastructure. We're going to reindustrialize. We're going to keep building data centers. We're going to build nuclear power plants. Like the physical infrastructure, the reindustrialization of America, I don't think is like a 1 or 2 year story. I think this is going to be happening for like a decade plus
Right.
as we try to reverse like the past 30 years and just become a little bit more self-sufficient. And by the way, it makes sense to do that because the cheap labor abroad's going away. China's population's peaked and started to decline. If you like AI and automation, right? If I can build a factory in China that's 100% automated and a factory in the United States that's 100% automated, there's no benefit to cheap Chinese labor anymore, right?
Right.
So, like AI and automation actually accelerates deglobalization, in my opinion. I think it like reinforces this trend. You know, the Doge stuff. Okay, I mean that's a whole rabbit hole we don't have time to go down today,
Sure.
probably. But like just deregulation in general. Okay, one of the most regulated parts of the United States economy the past 30 years is like physical infrastructure. It takes 5 to 10 years to break ground on like big infrastructure projects because you have to do like the environmental impact study and make sure like this the turtle or the sage grouse or whatever's environment's not disrupted. And like, you know, that's all fine. But if we want to reindustrialize and be more self-sufficient, I think you're going to see a lot of movement on like permitting reform and expediting infrastructure approvals and things like this. I think that's all part of this deregulation push we're seeing from the Trump
Eliminate
administration.
the red tape.
Yeah, so I'm pretty optimistic about that sector of the economy, right? And that's a huge reversal because the past, I mean, really, it's since 08, 09 that tech, mega cap tech's become like a big thing, right? But like most of the investment returns, most of like, I guess like the priority in the economy has been about, hey, these big software companies that have, they help us sell ads or whatever else, right? And cloud computing and everything. I'm not like trying to minimize those things, but they're sort of like in the digital world. I think we're going to see much more focus on like the physical world.
Yeah. Yeah, I would agree. And I think that, like you pointed out, when we saw the breakdown during COVID and getting everything we needed into America, it was nearly impossible. And so having all of those things here in this country, I think will be beneficial long term. So, well, my man, I appreciate your insight. I think this is something that we want to continue to do. Obviously, there's going to be, in my opinion, I think the word volatility is going to be here for a while.
Yeah.
I think that's going to be something that we're going to, every headline that we're going to see over the next year, 2 years. I mean, maybe even through this whole presidency is going to be volatility. Would you agree?
Yeah, no, I think that's absolutely right. And again, I would just emphasize interest rates, right? The past 30 years, the Fed's had its thumb on the scale. It's made the 10-year treasury yield and like basically the whole treasury curve very stable. You don't see like big moves in interest rates.
Right.
So now the Fed's had to step completely away from the market. They're not buying treasuries anymore. They're not helping control the price of US debt anymore. And so that leaves investors domestically to buy it all, and we care about the price that we're being paid, right?
Yeah.
So it's caused all these market-based moves in interest rates at the long end of the curve. And when interest rates bounce around like tech stocks, like your government bonds are supposed to like tamp down volatility in your portfolio. They haven't done that the past couple of years, right? So that's where I think the volatility is really coming from.
How long does that take to shake out? So, like, as we go from, the quantitative easing and quantitative tightening, getting the Fed really out of controlling the market, is that something that's going to take, 5 years to figure itself out? Or is that something that can be done in a shorter time period?
Well, I think it's really about cutting government spending, or like just maybe a better way to put it is like injecting confidence into the US Treasury market, because a lot of people just look at the debt situation and like the US budget situation and they say, "Hey, I want to get paid more for like the debt that I'm holding long term from you guys." And so if you can cut some government spending and like make people a little bit more comfortable around the situation and hey, like someone's actually taking care of this and doing like making some hard decisions, I think all of a sudden you see a lot less volatility. in the US debt market. So I mean, that could be in, what is it, like 2025, 2026, like 4th of July next year. They're supposed to give their official recommendation. And maybe at that point, Congress follows through and we make some adjustments to the budget. They're not easy, but they have to be done. And then, hey, the worst of it's behind us. Or conversely, hey, we just kick the can down the road, things get worse and worse, and you just continue to have this crazy volatility in interest rates. So I think it can be fixed relatively quickly, frankly. It's just, can the Trump administration follow through?
Yeah. Can the decisions be made? Any other things that you think that would be beneficial to add on a closing point?
I would just say, I guess this is like my evergreen sort of piece of advice to people, but being informed is important. I'm not telling people to not be informed, right? But just to understand like the economics of the modern media ecosystem, right? The way that they make money is selling ads. The way they sell ads is keeping you engaged to content, right? And there's been decades and decades and decades of study academically in like marketing and psychology and everything else that says people are 10 times as engaged with media sources when they have like a negative bias, right? You care more when you think the world is going to end. So I just think media companies in general have a huge incentive to program their algorithms or curate their content around a negative bias and outlook. And I would just say, like, listen, things are pretty good. The US economy is going to be fine here. We have a lot of natural advantages. I think, like the tariff story here is a great example of this. It's a very small impact on the economy overall. A market correction is pretty normal typically. And so when we're being told like the world's falling apart, I think it's just a good example of like, this is how their business models work. So just, keep that in mind, right? Is all I would say. Social media is the exact same way, right? Everything is sort of built around a negative bias because it keeps you engaged and keeps, like that way they can sell Surfshark VPN and like AG1 and whatever else, right? Flowmax. I don't know what's like Fox News, what are the advertisers, but you guys kind of get it, right?
Yeah. So basically go back to like when we were growing up, get your news in 30 minutes and go out and smell the roses.
Yeah, like go outside, walk around with the sun on your face. You're gonna feel way better immediately. Um, the reality is like things in the United States, like the entire economy can't fall apart in 30 days, right? It's just not. We have way too many natural advantages, way too much like capital investment and education and human capital and like the military, like all this stuff is built up. It doesn't just fall apart in 30 days.
Yeah. Awesome. All right. Well, thanks again, buddy. I appreciate you. And we will see you on the 27th.
Absolutely, man. Looking forward to it.
All right. You guys have a great day. We'll talk to you later.
Okay, see ya.
See ya.